please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Overnight was the Fed hiking interest rates by 25 basis points. So to discuss that further, we're now joined by Seth R Freeman, the CEO and Chief Investment Officer at EM Capital Management. Thanks a lot, Seth, for joining in first. First up, just wanted to know, what do you make of the Fed's decision yesterday? Are you surprised that they increased their growth outlook but kept the number of rate hikes unchanged for next year?
Not very surprised. Frankly, many of the words from Chair Yellen were very similar to the previous or prior announcement in terms of the economy performing well. I think the biggest difference is the outlook towards inflation and some concern going forward for what the impact of fiscal policy might be.
Okay, Seth, what is your sense? There are experts who are saying that despite the projections that are pointing at a hawkish tone, the overall statement coming in the press conference was a bit dovish. What's your sense?
Yeah, it was just kind of restrained, I would say. We're looking at a booming employment in relative terms, and they're looking for that to even become better. I think they were talking about 3.9%, but we are not seeing wage growth, and that's really helping constrain and delay the inflation targets that they're looking at. So it wasn't much of a surprise. I think looking at Asia already, and even looking at the Mexican peso in the afternoon, the idea of 3 rate increases at 25 basis points each, I guess you're right, it's fairly dovish and conservative.
All right, dovish and conservative, Seth. So with regards to how things stack up right now from both the fiscal and the monetary policy perspective, and the fact that the equity markets are at yet another record high, what do you think is the trigger for further upside for the markets? And would you put more money to work right now?
Well, I was even on a personal level looking at lightening up some of our equity holdings, and it does appear that because markets in Europe, Asia, the U.S. are pretty much in unison and strengthening, that I think this is good for equities. Equities are very forward-looking. And so I think that the continued records we've been seeing bodes well, at least for the next 6 to 9 months.
Okay, you talked about lightening your position in U.S. equities, but if that's the case, where are you putting that money now? Are you putting more in the Indian markets then?
Well, I think that there's still a huge opportunity in the Indian markets, as I have for 14 years now, and it's been well rewarded. India's going through some slowness, some lag period from demonetization, slow GST implementation, and so forth. But it's still very positive, and overall growth rates should be significantly higher than the U.S.
All right, that's positive news coming in for the Indian investors as well as the Indian markets, saying that the overall outlook for the Indian markets, despite the slowdown, is positive. Thanks a lot, Seth, so much for joining in and giving us